given some of the mega trends over the medium term, I think we still are very bullish on those commodities like copper, like EV, battery materials, and the metals that are used within that space.
Welcome viewers to this presentation on where next for the metals and mining industry. We're going to hear an expert analysis of how mining is entering a new growth cycle, some of the top challenges facing African mining specifically. Presenting for us today, I'm very pleased to introduce Greg Callaway, who is metals and mining industry expert at McKinsey & Company. Greg, welcome back. Great to have you with us again. Please take us through your sector analysis.
Thanks very much, Adam. Great to be here today. For those who don't know me, as Adam said, I'm a metals and mining expert with McKinsey Company. I'm based out of our Johannesburg office here in South Africa, but serve clients globally on topics of growth strategy, marketing and sales across the value chain, as well as lead our work on commodity dynamics. I'm particularly focused on the areas of copper and gold, but have deep experience across the sector, and very excited to speak to you today on a topic that I'm particularly passionate about. Today I will talk a little bit about where we've come from in 2020 with COVID and what we saw happen, and why we are going forward bullish about commodities. That said, if we're looking at the cycle upcoming, it's very different to what we saw in the past, and we're going to see growth nuanced by commodity with leaders and laggards emerging. Given where we have come from and the lack of investment, we think that the incentive supply in order to meet demand is going to require additional projects to enter that pipeline, and there's various ways in which that can happen, and in this case Africa plays an important role in doing so. With the deficits that we see ensuing, well, this is going to place upward pressure on prices, making the industry attractive and generating value pools for mining companies and those along the value chain to capture. How you strategically do that will differ by company to company, but a place where value can be captured for all. And then lastly, you bring this back to an African perspective. Like I said, Africa is going to play an important role, particularly as we go forward with deficits ensuing, implying growth projects required to close that gap, additional exploration, moving from where we had previously explored to new elephant country, as they would so say. And then lastly, looking at technology and the importance going forward. So where have we come from in 2020? 2020, we saw massive volatility hit the commodity market, with COVID driving the way. In the first half, we saw prices plunge across the board, down to marginal costs to produce levels. Copper going from $6,000 all the way down to $4,400 or so in March. We then towards the latter half of the year, as we came to terms with the pandemic, saw a great recovery in commodity prices. And what we see on the chart here is that by the end of the year, our basket commodity price index actually well surpassed levels that we saw at the start of the year, finishing at 109. This tending towards levels that we saw towards the boom periods in many instances. What drove this? Well, we saw strong demand coming out of China and Southeast Asia. China, particularly with the proactive measures that they took to drive infrastructure spend, and that accompanied with various metal demands that are linked to those spaces. I'll get into a little bit more detail that as well. We also saw out of Southeast Asia, well, Vietnam, Indonesia also surpassed what we saw analysts expect, particularly with their ability to control the virus, as well as continue to grow manufacturing output. On the converse, when it came to supply, a number of supply constraints impacting the market, creating a very tight market. And while with increased trading activity happening, particularly with investors looking to move between various asset classes, commodities being attractive, those investors and the heat that came with it drove up commodity prices. And so if I had to summarize 2020 in itself, it would be described as a year of volatility, volatility, volatility. And I think going forward, this volatility that we've seen is likely to continue, and something that players across the value chain should keep an eye out for. So what does this mean going forward for commodity markets? Well, we remain highly bullish regarding commodities, with commodity revenues as well as margins for the industry expected to grow over the next decade. Revenues growing by some 30 to 45%, and similarly for that of your EBITDA to mining companies. If we're looking at how these revenues are expected to grow, we think by the end of 2030, these revenues will surpass those levels seen at the peak of the commodity boom that peaked in 2011. If we see a further devaluation of currencies, particularly the US dollar in this respect, this is going to put upward pressure on commodity prices and accelerate that growth in revenue, possibly bringing it as early as 2023. And so while we remain attractive, or while we think that commodities will remain attractive, we think that COVID-19 has played a part and is the beginning of a much longer structural bull market for commodities. And so how do we get there? Well, we think that there are a number of megatrends that are going to shape the commodities market over the coming decade, namely coming from growth out of the middle class in developing markets. We saw China and its rapid growth, but there's still a Indian and Southeast Asian market which continues to expand, albeit from a very low base. China will continue to have a important role in shaping the global economy, as well as the metal demand that is implicated with that. And then particularly, we talked historically about China shifting from a infrastructure-related market to a consumer market. Consumer markets will change. They have changed because of COVID and the way we operate. More e-commerce taking place, more electronics, more IT elements really impacting the market. Also, electrification, particularly as changing energy mixes shape the market, moving away from your fossil fuels towards more renewables. Expansion of grids in emerging markets will play a role. But importantly, what we've seen over the last couple of years is the impact that activist investors and shareholders have had on your companies and how they operate. And so one, recycling, we see that recycling, particularly the next wave of scrap availability hitting the market, given historical demand acceleration in China, is going to have an impact, and the balance in supply. And then, like I said, your active investors and ESG, I think namely around carbon emissions. So we, shifting on to how businesses have operate in the pressure that they receive from activist investors and shareholders, recycling as well as ESG is going to have a fundamental shift in the business model of mining companies and companies across the value chain. We see that with recycling, particularly the massive step up in demand from China over the last 20 to 30 years. This will feed back into the market, creating a new source of material and play a role in the balance of supply between primary and secondary. And then ESG, a big topic that has emerged in recent years. We think it will continue and is an imperative for companies, particularly when we're talking about carbon emissions. And then, more importantly, and to note, resource nationalism has played a role in companies, particularly in emerging markets, in how they interact with governments. And so, this trend is likely to continue. And lastly, digitization. Well, the mining industry was slow to adopt in many instances, but is at full force. And one of the differences that we've seen to a decade ago is the impact of automation, digitization, and the Internet of Things on how mining companies operate. What I would note is coming out of COVID, the impact of COVID in many respects has been to accelerate certain of these megatrends. No more than the infrastructure spend and stimulus packages in China, which is focused on upgrading its infrastructure to high-tech applications, looking at big data centers, 5G, EV charging stations. We look at the EU Green Deal, looking to spend money on its climate action. And then more recently, when we look at the US and with the adoption and transition towards renewables and clean energy, will have an impact. And so COVID in many respects has accelerated this transition and the impact of many of these mega trends. What does this mean for demand? Well, unlike the super cycle that we saw driven by China in the 2000s, where commodity demand across the board was accelerated, commodity prices across the board rose to record highs. The trends that are expected to occur going forward are going to be slightly different. And what I mean by this is a nuanced growth pattern where we see elements like EV battery materials, anti-rust commodities, copper, all accelerating because of the mega trends. But on the flip side, energy materials and steel-making raw materials really facing headwinds in their growth. I think it's important to note here as well that the trends that we see impacting the market, many industry players as well as analysts haven't fully grasped the impact. We ran an analysis looking at copper and the impact from Tesla Day and what Elon Musk had to say at the end of last year and the implications for the copper industry. In short, if we're looking at Tesla and what they're forecasting, they believe that the consumption of energy is expected to reach 20 terawatts by 2030. That is an order of magnitude higher than what our internal estimates of 2.5 stand at. This, just looking purely at the implication for batteries, the additional foil, the additional number of electric vehicles expected to hit the market could increase copper demand by 5 million tons. 5 million tons is the equivalent of roughly 20 to 25 Cerro Verde or Elton Yante expansions over the next 10 years. These are projects that still need to be discovered and will need to enter the pipeline. And so the takeaway here is that we are still trying to get a grasp of the implications that our renewables are playing on the market and some of the mega trends, and that these growth rates could accelerate even further in the future. What does this mean for supply? Well, supply in many respects is faced pressure over recent times, and if we look going forward, we think that global mine supply across all commodities, the new brownfield projects and greenfield projects expected and announced by companies to date are pretty much meeting the closures that have been announced. And so mine supply as it stands today is relatively flat. I talked about the importance of recycling, and we think that recycling could grow significantly, but even with this growth in supply, in secondary supply, there's going to be a shortfall when it comes to demand. And that shortfall, that incentivized supply required to meet demand, is roughly equivalent to the announced brownfield/greenfield projects. What is really shaping this? Well, there's three factors in particular. One is around growth, capex, and this capex being spent by companies. Two is around exploration and the amount of exploration and how that exploration is being done. And three is about productivity. All three of these factors have faced significant headwinds in recent times, and a change is needed by the industry going forward if we want to see supply equal to demand. If we're looking about capex, as of 2020, we estimate there's been roughly around $150 billion deficit over the 6-year period leading to that, and that in order for us to meet future requirements, capital expenditure will need to grow by roughly around 10% year on year, with growth capex into projects exceeding $100 billion by 2025. What is, why have we seen this underinvestment? Well, in many respects, it has been because of conservative nature of the industry coming from the highs in 2011, and pressure being put on mining CEOs to perform, to show value, that have really created a conservative nature within the industry. Couple this with projects shifting to more remote locations, deeper deposits, and the introduction of autonomous vehicles. All these are going to have an impact on increasing the capital need to deliver projects over the next 5 years, and will support that further growth in capex over the time period. Exploration, similar sort of story. What we saw is that coming into the 2000s, there was a fundamental shift in the way the industry looked at exploration, where exploration was largely left to your junior miners to find those greenfield projects, those big tier 1 assets that really helped the industry sustain its levels. And so we saw a lot more exploration focused on near horizons around existing assets. This approach did not lead to the discoveries and the identification of tier one assets. And so we've seen a significant decline, particularly in the last 10 years, in the rate of discoveries and feeding that your growth pipeline going forward. What is needed by the industry is particularly for exploration to be a priority, particularly between your majors and your juniors, whether it be through partnerships, mergers, of sorts, to develop the next wave of project, and not focus particularly on those areas that have been discovered and all drilled out, but move into elephant country per se, and discover those next horizon of greenfield projects. And then lastly, it's around productivity, and productivity has increased marginally over the last 8 to 10 years, after being significantly impacted by decisions made by the industry in the China boom period, where volumes at all cost were the name of the game. We've now reverted back to looking at value economics for the industry and making sure that the returns meet the input for the market. That said, if we bring this back to what's happening in Africa, well, Africa has underperformed its global peers in many respects, underperforming in terms of productivity, both when we talk about productivity in terms of volumes moved, but as well as your labor efficiencies. And this is both in open pit as well as underground activities. I'll get to it just now. We'll talk about technology and how technology is required and an imperative for Africa to remain competitive going forward. So all in all, we talked about growing demand, tightness in supply, and the need to grow supply. This is going to have an impact on attractiveness for the industry. And when we think about attractiveness, McKinsey has a framework looking at price regimes. Now, price regimes are the premium above the marginal cost to produce. And so tight price premiums are typically linked to prices, commodity prices near the margin, whereas fly-ups are those that are higher, and create excessive amounts of value that allow companies to go for and develop projects without little concern of some of the underlying characteristics. And so on the left-hand side of the chart in front of you, cash cost is a fairly tight market, while on the right-hand side we move to more attractive. Cash cost being, as I said, looking at the margins, how businesses operate on a day-to-day basis. Brownfield, where you have the ability and prices are attractive enough that you can explore around the perimeter of existing operations. Greenfield, giving you the ability to explore further, but taking into consideration the additional infrastructure and capital to develop in remote locations in many instances. And then fly up here at this point, prices are attractive enough that most projects will meet hurdle requirements and be able to be executed upon. And so if we look at where we stand at the end of 2020, well, with the recovery in commodity prices, iron ore, copper, as well as gold, highly attractive, and miners are making large margins. If we move forward over the next 5 to 10 years, well, here we see that many commodities are expected to remain attractive, because of the deficit that we talked about, and commodities like copper, your EV battery materials, fertilized gold, all operating in that brownfield to greenfield space. What we also need to note about is the importance of China when it comes to price formation, and particularly those commodities that are important to Africa. What we see is that China remains a key factor in the influencing and the mechanics behind commodity prices. Particularly if you're looking at something like gold, China, largest producer globally of gold, but also a significant influence when it comes to consumption, particularly in your jewelry sectors. We look at iron ore, seaborne market. China is a large consumer of iron ore, and so understanding the role that China has to play in various commodities will help us understand the potential implications that decision making in China, whether it be policy, mining, M&A strategies, will have on pricing dynamics, particularly for those in Africa. And you can see that diamonds, PGMs, high grade iron ore, these are commodities that China will continue to source and require to be sourced outside of its borders, while low grade iron ore, thermal coal, China has a market internally that can potentially self-sustain itself. And so each of these will have different implications for the commodities in Africa and what Africa produces. So how do miners then capture some of the value that are expected to emerge over the next decade? Well, we think that there are 4 broad themes that mining CEO need to have top of agenda. Growth and productivity, these have largely been on the agenda thus far. We're talking about portfolio optimization and reallocation of resources to take advantage of some of these tailwinds that we think will emerge over the next decade. But then this will come from both focusing on exploration as well as M&A. If we look at Africa in particular, particularly as mining companies look to grow, emerging markets, Africa will play an important role both in the exploration plays as well as the execution of new projects. Productivity, I'll talk a little about the imperative of Africa going forward to focus on productivity, but with the introduction of automation, digitization, and process digitization over the last decade by mining companies, those that aren't able to take advantage and restructure themselves to incorporate this are being left behind. And then what has emerged and will be an imperative going forward is around your ESG topics. We think that the key role here for ESG in the immediate future will be around carbon emissions and understanding carbon emissions across the value chain and the implication of decision makings. Some of the work that we've done so far shows that underground operations versus open pit operations are 50% less carbon emitting than open pits. And so particularly as generalist investors move into certain commodities because of their attractiveness, the decision making that they have top of mind is often around the economics of the mine, but also your ESG scorecard. So the takeaway here is that your shareholders, your investors, are going to continue to drive the change that we see mining companies take in the space for the future to come. Let's bring it back to Africa, and what are the implications for Africa? Well, just to set the context, Africa large-scale mining generates approximately 76 billion in revenue and employs more than 645,000 employees across 28 countries, more than 400 projects, and generates about $10 billion in taxes that can then be used by governments. Comparatively to the countries, Africa relies significantly on these taxes for the development of its economies. Ensuing deficits, well, Africa's going to, as I said before, play an important role in closing that supply-demand gap, both looking at how exploration is done, as well as projects expected to come online. But what we note, and some of the work that we've done around technology and the imperative of technology, is that Africa, given the low productivity that we've seen, needs to focus on some of the work that is being done in productivity, and looking at the levers of digitization and DNA, process digitization and automation. We think that there's roughly around $10 billion that can be captured by African mining over the next 2 decades, with 70% of that being low-hanging fruit coming from your DNA, your advanced analytics, as well as your process digitization. What makes this attractive is that it can be comparatively easily implemented at operations. Value can be created comparatively to automation, which requires a little bit more capital and has a longer lead time to seeing some of the value coming out. We ran an analysis looking at where commodities are positioned on their various cost curves, and what we note typically is that Africa is well distributed through curves. If we take a scenario where all players globally implement various technological levers, Africa holds its competitiveness across the various commodities. That said, in a world where Africa fails to adopt, we see a significant shift of projects that were originally located in Q1, Q2, Q3 on the cost curve into Q4, with the biggest implication being for both the gold and copper industries for Africa. This means that 60% of revenues and 55% of jobs will lie in that part of the cost curve that is susceptible to volatility, has a higher risk of uncertainties attached to it, and holds a higher likelihood linked to closures. And so the imperative for Africa is, how does it remain competitive, continue to grow, take advantage of the tailwinds, but also stay up to speed with the advancements that we're seeing in productivity over the next decade or two. So in summary, 2020 was a volatile year and has set the tone for what we think is a longer structural bull market for commodities. The difference versus what we saw in the 2000s with the China boom is a differentiated demand with commodities like EV battery materials, which includes your nickel, cobalt, lithium, and copper will grow at attractive rates, whereas your steel making raw materials will face headwinds. Given the lack of capital spent over the last 6 years or so, significant amount of spend is required, 10% year on year over the next 5 years, in order for your supply to meet your demand requirements. And this is where Africa will play an important role in closing that gap, shifting away from traditional locations and taking advantage of some of the low-hanging fruit, the greenfield opportunities, the undiscovered areas within the African landscape. Supply deficits. This will create upward pressure on many commodities, making them attractive, creating large value pools that can be captured by mining companies. In order to do so, companies will need to focus on growth, focus on productivity and ESG within their business model. And particularly when it comes to African mining companies, technology will be an imperative in order for Africa to remain relevant over the next decade or two, with roughly around $10 billion to be gained through technology. Adam, thank you very much. This has been great to share our view. We look forward to hearing from many of those that have listened in today.
Excellent. Thank you very much, Greg. Really good analysis there. We've just got 2 or 3 minutes. I guess I could ask a couple of questions, if you don't mind.
Sure.
Yeah, I was curious just to delve into perhaps some of the strategies of mining companies. Obviously, you touched on a few of them on what the McKinsey view is on recommendations, but what are some of the strategies of mining companies going forward if we're thinking about the challenges of low discovery rates, underinvestment in exploration? You see this period or this decade from 2020 as that increased CapEx investment period. Does that mean companies are going to be looking more at spend on greenfield exploration, certainly the mid and major tier miners, or do you think M&A is going to keep very firmly on the agenda?
That's a great question, Adam. And I think if you're looking at mining companies, they're going to have to pull a number of levers in order to capture the value and close the gap. It's never about relying on a single one in order to do so. What we've seen in the past is those that have been successful have at least pulled 2, if not more of them in order to do so. M&A, I think, if we're looking at mining CEOs, they were particularly burnt coming out of the commodity boom in 2011 and have been a lot more cautious in how they go about it. But that said, I think there's opportunity going forward. We've seen a couple of big deals in 2020 by mid-tier gold players in order to take advantage of where the industry is at. We currently hit at historical lows, and so in order for the industry in an M&A space to really close the gap, we're going to have to see a significant amount of M&A. That said, exploration is going to be just as important, and we think that Africa will play a particular role, particularly as those areas that have been looked at. Mining companies know extremely well. They've explored the areas around them, and companies are going to have to go into new territories to discover those next series of tier 1 assets. In many respects, Africa has lagged behind regions like Latin America, North America, Australia, historically. And so, those two, coupled with looking at technology to increase volumes volume throughput will be, each in their own important, and how companies take advantage of that will depend on their current situation and where their strengths lie.
Excellent. Yep. Very comprehensive. Okay. My other question was more broadly on the commodities analysis. We're in this structural bull market you mentioned, but is this as good as it gets in terms of copper and gold companies in terms of their bullish price already from last year? And where do you think the main, obviously copper supply tightness is highlighted as a major issue, but within those two, where do you think the main sort of challenges are with these two particularly sought after commodities?
Good question, Adam. I think if we go back a year ago and looked at what the forecasts, the analysts were putting out there, we in a completely different space today. Having come out of COVID, dynamics in the industry are different, and so the takeaway here is that like volatility and certainty around markets is not an easy thing to do, and it's not something that many people have fully comprehended, and so there's many moving parts that have driven this volatility. I think what I would say is that I see a scenario where a weaker dollar, a dollar crash, drives investors to move monies into emerging markets, that further holding all inputs costs constant will drive up your dollar denominated commodity prices, and so we see further upside if you have a look at the world in that space. That said, you could see investors move out of commodities, holding a vaccine and a strong recovery in the US back into equities, bonds, and we could see a correction back to more normal levels. What I would say is, given some of the mega trends over the medium term, I think we still are very bullish on those commodities like copper, like EV battery materials, and the metals that are used within that space, given the strong demand and tightness in supply. Gold, given the structure of the cost curve, rising debt by many nations, and political instability, continues to remain attractive. That said, if I look at the other basket of commodities maybe not mentioned, I'm not down on them at all. I think within each commodity, projects will continue to make good margins and be attractive for investors under certain conditions. Particularly if you're looking at iron ore and coals with high grade projects, particularly gaining a premium versus some of their competitors that have lower grade materials. So within each of the commodity spectrum, I think there's an opportunity for value to be captured, and it's a matter of looking at those projects on a individual basis.
Yep, certainly. It's a tricky question to sort of sum up in one with so many variables and potential outcomes. But yeah, generally a bullish period, which is always positive for the industry to take to the next level. Greg, thanks very much for presenting for us today. That's excellent stuff, and that's going to be available online and pushed out through the Assay Weekly. So thank you very much for your presentation.